Hi, I'm your host, Bob Powell. We're proud to welcome you to the Exceptional Advisor podcast series brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. Today, we continue with the third episode in a multi-part sponsored series with Delaware Life Marketing. I'm happy to introduce two guests today. Wade Pfau, Professor of Retirement Income in the PhD in Financial and Retirement Planning Program, co-director of the American College Center for Retirement Income, and RICP Program Director at the American College of Financial Services, and Anders Smith, Vice President and Head of National Sales Consulting at Delaware Life Marketing. Gentlemen, welcome.
Thanks, Bob. Great to be here.
Yeah,
Great to have you. So before we get going, for the benefit of our listeners who may not be familiar with you and your work, do you mind giving us a brief overview? Anders, you want to go first?
Sure, Bob. Great to be here again. Thanks for having us. I'm Anders Smith. I have the privilege of leading the National Sales Consulting team at Delaware Life. I have been in this business for 35 years, starting with MFS Investments back in 1986. Spent 14 years with Nuveen Investments and have been now with Delaware Life for about 4 years. So delighted to be part of the conversation today.
Wade?
Sure. I'm Wade Pfau. I'm with the American College of Financial Services, and I'm the director of our Retirement Income Certified Professional Program. I do a lot of research in retirement planning. Most recently wrote the Retirement Planning Guidebook, and now increasingly looking at this idea of retirement income style awareness.
So I think that's a good segue, Wade. We recently published a paper that you co-wrote in the Retirement Management Journal, published by the Investments and Wealth Institute, that does a deep dive in RISA, or short for. I'll let you explain it and what it does and how people can use it.
Sure. It's bringing the idea of, we've known for a long time there's different retirement strategies. We've got the total returns investing. We've got the time segmentation or bucketing. We have the floor and upside approach that in the RISA, the retirement income style awareness, we divide between income protection and also risk wrap as two different ways of thinking about building that floor. But ultimately, the question was, how does someone choose a strategy to start with? And I think for so long, it's really, people don't have a clear path to do that. They may listen to the consumer media, they may read a blog, they may talk to a financial advisor, but ultimately they may not end up with a strategy that resonates with them. So we really looked at what are the factors that explains how someone thinks about retirement? What are the kind of trade-offs involved? How can we identify their preferences? And ultimately think we've come to understand a way to, just as a starting point for retirement planning, before you think about anything else, before you even get to things like risk tolerance questionnaires, how do you want to approach building your reliable income piece? How do you want to manage your essential spending needs in retirement? And then understanding the characteristics that can translate into the different strategies that we've known about for retirement planning.
So my understanding is that folks who participate in this go through a questionnaire that results in them falling into one of four quadrants?
That's right. Yes. And the questionnaire began as a research project. So initially, with all the elements involved, could be up to 45 minutes, but we've streamlined it that if you really just want to get a sense of somebody's retirement style, we've now been able to get it down to as short as 12 questions to identify the two core sets of preferences that really came to play the role in all this, where what I've always called probability-based versus safety first. And that's getting at this idea of, are you comfortable relying on market growth to fund your essential spending, or do you prefer some sort of contractual protection? And then the other key characteristic that I wouldn't have predicted in advance, but it was this idea of optionality versus commitment. Do you want to keep your options open as much as possible to make changes and respond to new situations? Or are you comfortable committing to a strategy that you know will solve for your lifetime income need? And you can check it off your to-do list to some extent. And so how people score, it leads to the four strategies. If you're probability-based, comfortable with market growth, and you're optionality-oriented, that would be more of that total returns investing approach that it seems like so much of the consumer media points to that as a starting point. But at the same time, we think now with the Alliance for Lifetime Income, we've done a nationally representative survey, and it looks like about a third of the population, as they approach retirement, may really resonate with that. If you're more safety first, contractual protection oriented with your thinking, as well as comfortable committing to a strategy, That's what we call income protection. That's about a third of the population as well. And that's looking at more simple income annuities and so forth to build the floor and then investing on top of that. And then safety first and optionality oriented, that's that bucketing or time segmentation approach. And then the probability based and commitment orientation, we call that risk wrap. And that's more about the discussion around like deferred annuities with living benefits as another way to build that lifetime income floor, but still provide exposure to market growth and so forth.
So I know I've gone through the questionnaire and I forget which quadrant I fell in, but nonetheless, it was a useful exercise. I'm also reminded of the fact that your preference may not be necessarily the strategy that you use. You may, for instance, in the case of someone who already has a defined benefit pension plan and an income annuity already, perhaps they may have enough of that strategy. And it may be that although that's what they prefer, they may need another strategy to complement what they already have in place.
Right. Well, it may be that they've already fulfilled that. Like if it's really about how do you want to source your reliable income? And if you already have a pension and Social Security and that more than covers what you need to cover basic essential spending needs, then right, the solution isn't that you would buy an annuity, but you've got your reliable income already. And then you have the flexibility with how you invest the difference at that point.
Yeah. Anders, you've been quiet throughout this stretch here. Anything to add?
Yeah, this work that Wade and his colleagues have done, I think, is brilliant, because what it really does is it evolves the whole conversation around addressing client needs and risk concerns to the distribution side of things, and allows advisors to really bucket their clients into those 4 different quadrants that he mentioned. And, and as you take a look at what advisors are doing and what they're providing for clients and how they can help clients continue to meet their needs, it's really about, and it's a competitive business out there, as we've talked about before, Bob, and they need to be able to demonstrate their value. They need to be able to show, hey, how can I really help you achieve your goals, and show you that what I'm doing for you has value. And there's the Russell study, The Value of an Advisor, which came out just about a year ago. An advisor adds tremendous value. And a lot of this ties in with the work here that Wade has done, because it allows the advisor to put the client in the right kind of solution. They have different needs. They address the market differently. Some are more geared towards that optionality, and they want the more, maybe systematic withdrawal approach and more opportunity for growth, whereas others want that safety first. Quite frankly, I think most of them want some combination. It's not just one or the other, but perhaps some combination. That's where the advisor, with their knowledge and expertise and using all the tools in their arsenal, can really provide that value and demonstrate how they can help them from tax planning, financial planning, portfolio management, and behavioral finance issues, making sure that they're in the right place to meet their needs so they stick with their investment solutions.
I should mention, Wade, that I have in my hand your book.
Great. Yeah, the Retirement Planning Guidebook.
As we're chatting, and does go into great detail into Teresa here. When we talk about preferences, there's the customer's preferences. There's also the preferences on the part of advisors, some of whom are fond of using the 4% rule to implement a retirement income plan. Let's talk more about that, if you don't mind.
Sure. Yeah. So the 4% rule, that's really the heart and soul of the total returns or the systematic withdrawals world, which just says, if you build it's really taking the pre-retirement investment philosophy and applying it to retirement, which is build a diversified investment portfolio, seek the highest risk-adjusted returns subject to your ability to stomach short-term market volatility. And that should pay off in the long run as a way to just take systematic distributions from that investment portfolio and fund your retirement that way. And Bill Bengen noted with US historical data, historically, the 4% rule is a percent of the initial retirement portfolio would have been sustainable over a 30-year retirement with 50 to 75% stocks. So it's calling for an aggressive asset allocation compared to where, say, target date funds and so forth are post-retirement. And I think it's a starting point that a lot of people think about, but ultimately, I do think that about 2/3 of the population may not be fully comfortable with the assumptions of that. A third of the population, great, go for it. But you've got to be comfortable with market growth, and you've got to really emphasize risk-adjusted return as being more important than having predictable income in retirement. And so those are some of the characteristics that define that total return strategy.
Yeah, and you, Wade, of course, have done research that have suggested that maybe 4% should be something lower when you look at not just U.S. markets, but markets around the world. And then more recently, the interest rates that we've had to deal with, low interest rate environment. talk more about perhaps the notion that maybe 4% is something less than 4% in the current environment?
Sure. Yeah. What got me started with all that was about 10 years ago, I had international data on 20 different countries. And though the 4% rule always worked in US data, it did not work around the world. It worked in Canada, but not the other 18 countries. Around the world, it worked about 2/3 of the time. And if you wanted a withdrawal rate that could have worked 90% of the time around the world, that would have been over 4% in the US, but it was 2.8% around the world. And that just led me down this avenue of, if we look at the low interest rate environment, the high stock market valuations, the fact that there's taxes, the fact that there's investment fees, the fact that 30 years isn't necessarily such a long-term planning horizon for, especially for a couple in their 60s, this whole host of factors that suggest 4% may not be as safe as that simple analysis about using US historical data would imply. And that if you want something that gives you that safety that you recognize with the 4% rule, that 3% is probably a much more realistic number, especially in this low interest rate environment.
Anders, any thoughts about the 4% rule?
Well, I think it's a starting point, and it's something certainly that many advisors have been using as that starting point for the conversation with clients about how much they may expect to receive. But many clients, I don't think, understand how it works. They don't understand the implications. We in our industry talk about it all the time. Clients might read about it in a money magazine or something and say, hey, what can I get 4%? So I think really we're from our perspective, what advisors can do and providing the application is, hey, let's start with that, but then let's talk about ways we can actually provide 4%, or what are the strategies or solutions that that are available to you that allow you to create an income stream that will at least get close to, if not even perhaps exceed, 4%, and provide some level of guaranteed income. Like a VA with the GLWB is something that provides that. And that's something that we'll talk about with advisors all the time. They don't necessarily think about that, incorporating that with the 4% rule conversation, but it's a terrific solution because you're laying off that risk. In a traditional 4%, the Bengen rule is not guaranteed, right? It's assuming the capital markets are what they were in 1994. We're 27 years later.
Yeah.
Things are very, very different today.
So for the benefit of our listeners who may not be familiar with the terminology that you just used, GLWB, do you mind defining what that is so folks know what?
Yeah, so a GLWB is a feature within many variable annuity contracts called a guaranteed living withdrawal benefit. And what it allows for a client to do is to create a pool of their assets, create assets that will grow at a certain rate, right? It could be 6%, 7%. It's called a roll-up rate for a period of time. And then at that time, they can then turn on an income stream that's guaranteed by the insurance company for life. It's not annuitized, but it's a guaranteed stream of income at a certain rate of distribution rate at that time. It could be 4.5%, 5%, 5.5%, depending on whether it's a joint life or a single life. But it provides that certainty of growth to a period of time, and then a certainty of income at that time.
So the 4% rule is one strategy that folks may prefer and advisors may use. There are other strategies. The bucket strategy, which sometimes goes by the term time segmentation or asset liability matching. Wade, do you want to walk us through what it is and the pros and cons of that approach?
Sure. Yeah, that's another one of these core retirement strategies that people have the choice to use. And so with total returns investing, you have your diversified portfolio of stocks and bonds, and really bonds are just playing the role of limiting the volatility of the overall asset allocation. With time segmentation or bucketing, you're really using bonds from a different perspective, which is to hold them to maturity to provide coverage for upcoming expenses. So if I had a time segmented approach, I might say, okay, for the next, you can decide how many years, but say 5 to 8 years, I'll use my bonds to have maturity for those bonds coming over those next 5 to 8 years. So I can have my spending covered through fixed income and I don't have to worry about market volatility. And then I'll build this growth portfolio for expenses beyond that short-term horizon. That would be my growth bucket. And then it kind of creates this behavioral concept of, well, I don't have to be as worried about stock market volatility because even if the stock market goes down, I have this window where I can spend my bonds and I don't have to sell stocks, and I'll keep my fingers crossed. It is still probability based in the sense of it's time diversification or believing that stocks will go up if I can leave them alone, but at least it can help manage that sequence of returns risk. And it can provide a compelling story for at least people to stick. Because another assumption of the 4% rule is people stick with their strategy and hold a high stock allocation and always rebalance and never panic and never sell after a market downturn. And so time segmentation may provide more psychological comfort to actually keep that aggressive asset allocation that a total return strategy would call for.
Right. Understanding.
Yeah, agreed. You bring up a great point, Wade. I mean, clients have emotions, and unfortunately will sometimes make poor decisions or be triggered by things that occur that we are out of control. And so again, using an annuity in that regard, I mean, in many ways, it almost forces a client to stick with their decision. And there's been research that actually shows that from Delbar that clients in sub-accounts and variable annuities tend to stick with their investments longer than they do in their equity mutual fund counterparts. And with that in mind, they've actually shown in that same research that the performance, they've actually outperformed their equity mutual fund counterparts over 1, 3, 5, 10, and 20 years. And it's kind of that forced discipline. So annuities can fit in well in that regard, but in the bucket strategy as well, as a fixed income alternative, you have opportunities to use annuities to get higher rates of return because you're laying off that risk to the insurance company. Institutionally, they can get higher returns, and you can still use it in the same way and get a higher return that was currently available in the marketplace today and in other CDs or money markets for sure.
And tax deferral too.
And
the big advantage.
The tax control.
So, Anders, I had the pleasure of being at Dalbar years ago when the qualitative analysis of investor behavior was first published, and I got to be the editor on the very first ever report of that. So I know that report well, and I've always been fond of quoting it myself. When I think about the bucket strategy, I think about it in terms of it being a strategy that allows you to sort of mix and match the total return approach with the safety first approach, in the sense that you're sort of combining these two approaches to create a level of, mental accounting, right, that allows you to not put your living expenses at risk in the short term, but also maybe manage the risk of loss of purchasing power by having a longer term portfolio in risky assets, so to speak.
Mm-hmm. Yeah, it's a hybrid strategy. And as it comes out with this retirement income style awareness, we do end up classifying it more as safety first just because of the contractual protection element of the short-term bucket being a way to get these opposing trade-offs. People want contractual protections, but they also want optionality. And those are not always consistent preferences, but you get it through holding bonds to maturity for the short-term expenses.
Right. So you mentioned safety first. This is one of the strategies. Talk more about that.
Mm-hmm. Yeah. And then now kind of working our way around the different strategies, the safety first side with contractual protections for people who are also comfortable committing to a strategy, that gets us into this world of income protection, which I know with the RMA designation as well as the RICP, this is the world of, I think RMA refers to it as the floor and upside, the first build a floor and then exposed to upside. We're building that sort of lifetime protected income floor through simple annuity products, and then investing for upside on top of that meets that desire to fund your essential spending through contractual protections and with a strategy where you're comfortable committing to a lifetime solution. In terms of secondary characteristics there, these are people who are more worried about outliving their assets. They do have a true liquidity mindset, which values like a life-only SPIA is not liquid, but it covers the assets to meet a particular spending goal that can create liquidity elsewhere on the balance sheet. It has more of a distribution focus where you're thinking about predictable income over just maximizing asset growth. And so it really has characteristics that fit into this sort of floor and upside type of a strategy.
Anders?
Agreed. And again, I think the two programs do address this in somewhat similar fashions, but that flooring, providing for those essential needs, essential income, identifying perhaps what the income gap might be, looking at what their income that they're planning on, whether it's from guaranteed sources, be it Social Security or a pension, and then what are those essential expenses that they really have? Was it housing? Obviously groceries, utilities, those types of things. Oftentimes there is a bit of a gap between those two. And so helping the client to identify that gap and then fill that gap is one of the most important things that an advisor can do. And then you can start to move up the scale, right? Meeting longevity issues, reserves, and then obviously upside opportunities using the pyramid in the RMA program. And again, annuities fit into any of those, but certainly in looking at ways to have efficiency of income to meet those essential expenses. And perhaps you can identify a pool of assets. And it's really about educating the clients effectively as they look at building that portfolio, what their assets are going to do for them, and educate them that, hey, we're going to set aside a certain amount that's going to purchase our income stream in the future. And understanding that that's not investment dollars. These are not dollars that we compare to a mutual fund or to a managed account, but these are dollars we're setting aside to make sure that we're addressing our income need in the future to provide for that flooring. So we know that you're going to have income for the rest of your life. You don't have to worry about that. And that puts clients at ease. It provides them some level of peace of mind that they know that that part's taken care of. So again, it's all part of the planning process, and where it fits in the, again, using all the tools in your tool bag to make sure that you're addressing all of their concerns and meeting all of their needs.
So we've talked about time segmentation, total return investing, income protection. The last quadrant is risk wrap. Did we not cover that?
Yeah, that's risk wrap, and that's more that world of variable annuities with living benefits. It's a probability-based approach. I'm comfortable relying on market growth, but also these are individuals who are also comfortable committing to a strategy. They have the longevity risk aversion. They're worried about outliving their assets, and so they don't want to be completely dependent on the stock market. And so that's where the insurance world developed these tools that can better meet the preferences of such individuals in terms of the variable annuity. You can invest in the sub accounts, you can get step up opportunities and growth of income throughout retirement. But at the same time, there's a downside level. No matter how poorly the market does, you're at least going to get this level of income no matter how long you live if you follow the terms of the contract. And that gives you, you're committing to a strategy, but you're also, because you're worried about outliving your assets, you get more comfort from the risk pooling ability to have that living benefit in place. And you do have more of this preference for technical liquidity, which is this idea that the variable annuity still is liquid. And so these individuals value that type of liquidity as well.
Anders?
No, my thought there is I'll just do a little bit of a plug in the sense that, as Wade speaks about variable annuities, we appreciate the fact that these can play a significant role in a client's portfolio. We feel we've got great solutions, and hopefully we've been able to open some folks' eyes a little bit that, hey, these meet a need. And as you look at creating these income and distribution portfolios, it's different than the accumulation portfolio. It's not just about looking at what the alpha is and what the standard deviation is. It's now looking at the different results. It's not, just helping them grow their assets, but now how do they efficiently and effectively take it out? And that's what we consult with advisors with every day, whether it's from tax planning strategies, distribution strategies that I'm talking about today. All of these fit into that risk wrap. But the reality is, as I think we mentioned earlier, any one of those different types of strategies, a bucket strategy, the systematic withdrawal strategy, can all achieve different objectives. It's the art of income planning, not just the science, and it's different than what you're doing in accumulation. It is a different mindset. So I would encourage folks to take a look at the RMA program and look at how you all approach that, because I've had the opportunity to go through that program among a couple of the others, and it's outstanding because it gives you that framework to create the conversation and provide the solutions effectively and integrate. There's all of these other elements to tie in here too. You're looking at Social Security, and you're looking at healthcare and all these other types of risks that clients might face, family risks, and so on, their own health issues that are unexpected, and you have to have a plan in place to address those. So it's a multifaceted approach. And again, what Wade and his colleagues have put together in terms of these quadrants and this whole RISA program is a nice framework to be able to segment clients out based on where they fall on that spectrum of solutions.
Yeah. You mentioned risk several times. It's one of my favorite topics to talk about. We just concluded the Investments and Wealth Institute had a conference in Florida where we had several speakers, Moshe Malefsky, Jason Fichtner from the Bipartisan Policy Commission, behavioral finance expert, all talking about risk. And among other things, two things when I think about risk. One is sort of the science of risk management, where you're thinking about what's the probability of something happening, high versus low, and then what are the consequences of it being negative, high, low, and then what is the risk management tactic or strategy that you would use to manage or mitigate the low probability, high consequence, or high consequence, low probability, right, et cetera. So maybe do you want to talk a little bit about the science of risk management? And then I want to talk about some of the specific risks that you mentioned a second ago.
You're asking me or if you're asking Wade?
I'm asking you both. I get the luxury of asking good questions and hoping that you guys give good answers.
This really is a fascinating piece of the whole puzzle, of course. And what you just brought up in terms of looking at the probability of a risk occurring and then the consequences that it might have is different for every client. And, some folks have very healthy families. They have prospects of living a very long time. So for them, healthcare may not be as big of a risk or big of an issue, but yet other folks who perhaps might have a history of dementia or other things in their family that could cause them to have significant healthcare costs early on. You just don't know. Every client is different or is unique, and the consequences can be significant. And so from an advisor's perspective, what a terrific opportunity to show the value that they bring to that relationship by educating the client about the strategy appropriate for them. And by being able to coordinate different solutions and create a suite of resources that's going to help them address those issues so that if they do come up, they're prepared. And this all goes into the whole concept. I know the retirement income policy statement is a big part of the overall RMA curriculum. And that's what you use as the blueprint for those conversations. It's like the investment policy statement, but focused on the income side of the equation. And it allows you to address those types of risks and the solutions that you're going to use for them. So again, we've got a great worksheet actually that breaks it out just like that. And it's something an advisor can use with a client to address what each risk is. What's the probability it might occur to you? What are the consequences if it does happen? And here's my solution for you. Here's how we can address it.
Wade, I know you're deep into this topic.
Sure. Like, I mean, in the investments world, we usually think of bonds as the less risky investment choice. But if you're trying to fund a spending goal and you're trying to spend more than the bond yield curve can support, it's a highly risky choice because it's just not going to give you the outcome you're looking for. So then do you seek the risk premium from the stock market as a way to spend more than bonds? Or do you seek the risk pooling of insurance as a way to spend more than bonds? And ultimately that it gets at the heart and soul of like this idea of probability-based versus safety first. There's this idea of time diversification that if you hold on to stocks for longer, some people would say they're less risky. Other people would say they're more risky. And it's just a matter of like with probability-based, the probability of a bad outcome, like a quote unquote kind of bad outcome, goes down over a longer holding period with stocks. But the worst case scenario outcomes, the probability of a very bad outcome goes up with a longer holding period for stocks. And so if you're more probability based, you're comfortable relying on time diversification, on this idea that probably things will work out pretty well over longer time horizons. If you're safety first, no, you really don't feel that comfort from the risk premium of the stock market. You'd really rather nail that down better with some sort of contractual protection. And then if you look to insurance for that contractual protection, you also get the risk pooling that is actually like competitive with the stock market. That's kind of when I'm agnostic about the approach people take, but with an investments only approach, I think there's this idea that stocks will always outperform the value of insurance. And I don't think that at all. I think they're actually pretty comparable in terms of risk pooling, offering a very competitive outcome compared to what the stock market can do. And so it's really then a matter of what's going to resonate best with the individual and how do they want to approach making those decisions. And both options are viable.
Yeah. So the other topic with respect to risk is we in the RMA curriculum have talk about risk. You in your book, Wade, talk about the various risks that people will face in retirement. The Society of Actuaries has another chart that looks at 15 risks, and they break it down. Others, all of us have broken it down by longevity, inflation, loss of purchasing power, spending risk, sequence of return risks, et cetera, et cetera, et cetera. And in my mind, there are sometimes tools that might be better used to manage or mitigate specific risks, right? So when I think about the risk of inflation, or let's take longevity, for example, right? There are many folks who would say that the best appropriate tool for managing longevity might be, say, an annuity, but the best tool for managing the risk of loss of purchasing power might be risky assets, a la the stocks. Any thoughts about using a specific tool for a specific risk, or is that not appropriate?
No, I think it's appropriate. It's you need an integrated strategy because different tools play a different role. So with the annuity, it's not so much that you're looking there for your liquidity and your growth potential and your inflation protection, but if you can more effectively earmark assets to meet a lifetime spending need through the annuity, then that frees up other assets where there's now more risk capacity. So, I mean, you could use tips for inflation protection, or you could seek a diversified growth portfolio to keep your fingers crossed for the inflation protection. But it's easier to do that when you first have earmarked a separate asset to meet the basic spending needs throughout retirement. And so you do have to draw from the different tools to help build an overall solution to manage these different risks.
I agree. I mean, what you've defined there really is you got your systematic and your unsystematic risks, right? Those risks that are going to affect everybody, like inflation, like market returns, et cetera, sequence of return, that's going to affect everybody. Or you've got your unsystematic risks, like healthcare, like longevity, that are very unique to the individual. So that's, again, the art of income planning, in that in identifying what those particular risks are for a client, there are different solutions for those different needs. And it's a combination of a number of things to address, because there is no one solution for everything. There is no target date fund specific for, for income planning. They're trying, but it doesn't really fill the bill. There are so many more nuances when it comes to income planning that are unique. Again, it goes to, understanding all the tools in your toolkit and being able to pull out the right ones at the right time.
Yeah. So when I think about advisors and their access to the tools, in some cases, they may not have access to all the tools, Anders. In those cases, is it wise to build out an affiliated team where you can provide all the solutions, or get the appropriate licenses or whatever that you might need?
Yeah, yes and yes, I guess, right? I mean, and we see a lot of advisors doing that, is part identifying in their practice, taking a look at what they do. And some advisors do some things incredibly well. They're very good at portfolio construction. They're very good at risk management, which is great, but they might not be good at income planning. They might not be a Social Security expert. They don't understand Medicare. So it's very difficult to be an expert in every one of those. So they identify, who can I partner with that can help me address this issue and provide this solution for my clients. And they create those relationships, and then they provide it, in that way. And there are different ways of doing it. Maybe you bring that person on your team and you have them as part of your practice. Maybe it's a referral relationship. All of them can do it in a way that makes sense for their practice. But we're seeing more and more of that occurring, or whether it's for a specific, look at like a business owner marketplace, right? There's so many different nuances in the business owner marketplace, from running the business, managing retirement issues, to running the business, succession planning, all these different needs that they have. And it's hard, again, to be expert in all of them. Same thing in income planning. You identify where your strengths are. What is it that you do that's better than anybody else? And then how can you accommodate those other needs, providing those experts in those other areas to provide those same level of expertise that you can provide in the areas that you're the best at.
Wade, any thoughts on that?
I think it's an important issue because it's with these different retirement strategies. Does the advisor want to specialize in one, or do they want to be able to reach a broader clientele? And ultimately, I know some advisors think that one strategy is the only way to go. A lot of total returns people, maybe a lot of insurance people. But at the end of the day, are you going to offer all the different solutions or focus on just one? And also increasingly to recognize that it's possible for a firm to provide more strategies. Like there are now fee-only annuities and so forth. It's not just a commission-based world. And so if you're an advisor who is used to fee-only as the way you get revenue, it is possible to incorporate annuities into that business model. And I think increasingly in the future, advisors who are open to serving different styles and strategies are going to be best positioned for long-term growth and success.
Yeah. So one more question, and then I'll open it up for maybe a little bit of a roundtable. But I think about this world of retirement income planning, and what we've witnessed over the years is new products, new regulations, new research, and the need for the advisor to sort of stay on top of all this, given all that's new and changing in this world. Any thoughts about that? Anders,
Well,
go first.
It's interesting. I've been doing this for 35 years, and it has changed so much, right, since mid-1980s, and it will continue to evolve, right? 5 years from now, it'll probably look very different than it does today. So as with any advisor, whether they're just getting started, whether mid-career, even getting later on in their career, it's, you have to continue to stay engaged with the community. I know IWI is a fantastic community to be a part of. The American College Wade's organization is a terrific community to be involved with. They keep you up to date as to what's going on, providing resources, designations that you can pursue or have people on your staff pursue to develop the expertise that's necessary. But, listen, it's a big market out there, and we also see advisors selecting specific target markets that they want to know inside and out, and focus on specific niches and provide all the needs and solutions for that particular niche, whether it's business owners, whether it's women, whether it's manufacturing firms, whether it's retirees. They then become expert, and that helps them focus their efforts, be much more efficient in how they deliver their services, which allows them to perhaps be more profitable, right, and end up being more successful for themselves, but it also serves their clients really well. Others choose to be much more comprehensive in terms of addressing and working with all types of clients. Every advisor is different. Regardless, identify what you want to do. And again, we consult with advisors on this. Identify what you want to do, how you want to do it, who you want to do it for, and then build your plan appropriately to manage your business and provide those services effectively.
Yeah, I think Anders had a great answer to that. I also work with a planning firm, and my inbox there is inundated with pitches for many different investment products and everything else. And it's really hard to cut through all that and to know what should I be paying attention to, or what is just some sort of marketing scheme that maybe doesn't have a whole lot of weight or heft behind it. But yeah, I think the answer was great in terms of keeping that relationship with disinterested third-party educational type institutions, whether it's the American College or the IWI and so forth, and using those resources to stay on the cutting edge of, what is a legitimate development within the financial services space and what might just be more of a marketing pitch.
Yeah. So we covered a lot of ground. Anything that we missed or anything that we've already covered that just bears re-emphasizing?
No, I think we went through the highlights of, thinking about retirement, there's so many other issues that also fit into it, but we're focused on the starting point more of how do you think about the basic retirement strategy? And that's an important first step for clients as they approach the retirement decision-making process.
Yeah, I'd encourage folks to maybe pick up Wade's book, because it provides a great outline for really looking at your clients and how they might be considering retirement income solutions for them, whether they want that probability or safety, or if they're more committed, want more of a committed kind of guaranteed type of solution. Think about, because almost every advisor does segment their book of business, their clients in some way, shape, or form. And this is another really useful tool as they maybe are shifting into their retirement years or already in their retirement years, what's most important to them. And you can then be much more focused and efficient in how you provide your services by knowing where they fit.
So, Anders, you recommend that folks pick up Wade's book. I'm going to tell them that they should also get in shape before they do, because it's nearly 500 pages and it is an encyclopedia. And I would concur. It's well worth every advisor having copy of that on their bookshelf. Anders, one last thing. This is one in a series of podcasts that we're doing with Delaware. What's coming up next? Any thoughts?
Yes. So we've got another podcast we'll be doing on Social Security and healthcare planning. We also have one that we'll be doing on more advanced strategies for distribution, things talking about spousal quadros and things along those lines. And then finally, I think our last one is going to be on estate planning strategies. So a number of different exciting topics that are down the pike.
All right. Well, gentlemen, Wade, Anders, thanks ever so much for sharing your knowledge and wisdom with our listeners.
Thanks, Bob. Have a great day.
Yeah, I appreciate it.
Thank you for listening to the Exceptional Advisor podcast brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.